Is the world still turning upside down? Well, the recent earthquakes in Japan have sparked a renewal of interest in the Earth's axial tilt and polar reversal. In the financial world, we're still recovering from the cataclysm that shook the system to its very foundations in 2008. It would be foolish to pretend that we're already out of the woods. A number of risks still remain. There is a sustained spike in the oil prices. Major sovereigns default. There's a risk of major sovereigns default as public debt surges. Add to that tensions over currency manipulation, new asset bubbles bursting, China's economy potentially crashing, and developed economies falling into a deflationary spiral. We attach a 50% chance to any of these events happening, which is a sobering thought. We also believe that there is still a 40% chance that we'll face a double-dip recession and that the Eurozone will break up. Of all African economies, South Africa is arguably the most exposed to the vicissitudes of global fortune. We have the most developed capital market on the continent. The JSE is the 20th largest securities exchange in the world and has a market cap of roughly $840 billion US. By way of comparison, the next largest on the continent are the Casablanca Exchange, the Egyptian Exchange, and the Nigerian Exchange, which isn't a member of the International Federation of Exchanges, but each of those has a market cap of roughly $70 billion US, so a substantial difference. The size and liquidity of the JSE means that it attracts the largest share of portfolio flows on the continent, and that also creates a vulnerability to rapid sell-offs that confront other emerging markets such as Brazil and Russia. In terms of trade flows, China is now South Africa's largest trade partner, both for imports and for exports. But net exposure is greatest to Germany, with whom we have a $4 billion trade deficit, compared to the $2.7 billion trade deficit that we have towards China. These are 2009 data. Only 17% of our exports go to other African countries. And I'll be talking a little bit more about openness with respect to trade later on. From a diversification point of view, mining still accounts for more than 50% of exports. The rand is still very much a commodity currency. Some of this effect is softened by gold exports because the gold price moves, as you know, acyclically and countercyclically. But gold is no longer our main commodity export. As the Minister also pointed out, it's a lot easier to trade the rand internationally than it is to trade other African currencies. And while it's still a small enough currency to be subject to cornering regardless of the legalities of that. So because of that, because of this exposure, the impact of key economic variables on the local economy is significant. Underlying these assumptions, very briefly, in the United States, a new round of fiscal stimulus, together with continued quantitative easing, will maintain the momentum of the recovery in 2011. Persistent unemployment remains a concern, but firms are likely to be more willing to hire this year. The deleveraging process still has several years to run, and that will weigh on medium-term economic growth. And in the property market, a large overhang of houses will present a recovery anytime soon. In Western Europe, Germany and the core are growing strongly, but fiscal austerity and high borrowing costs will hold back growth in the periphery. An increase in the financing available to the distressed Eurozone member states has led to an improvement in sentiment, but these measures will not resolve the solvency crisis. We expect Portugal to require a bailout in 2011, but that Spain will be able to meet its underlying needs in the markets. In Japan, the extent of the earthquake on the economy, the extent of the impact of the earthquake and the damage to the nuclear reactor is still unclear. And so for the time being in Japan, we've revised down our 2011 growth forecast from 1.6% to 1.4%. Further downgrades could follow depending on what happens with the power supply and other damage to infrastructure. In China, the massive stimulus has aggravated existing imbalances. Further tightening of monetary policy is certainly needed to tame inflation, and elsewhere in the emerging markets, monetary tightening is also needed to curb inflation. Nonetheless, growth is expected to remain strong on the back of domestic demand. As South Africa becomes more integrated with Africa, a trend that is well underway, the economy is likely to benefit from higher growth markets elsewhere on the continent, such as Angola, Mozambique, Ghana, and Nigeria, to name but a few. But as you can see here, South Africa's economy in 2010 grew more slowly than any other African economy. On the bright side, many of us were relieved that it did start to grow again at all, but it will remain resolutely below the average. Remember, though, that other economies in Africa are starting from a lower base. We do expect growth to continue picking up in South Africa, particularly as private consumption recovers, which brings me to what underlies our forecast for South African growth. So what are the drivers of growth in South Africa? Private consumption will resume its role as the largest contributor to GDP growth. You can see in 2009 the impact of the recession on spending by firms and households, and again the strong recovery last year. We expect consumer spending to peak, private consumption to peak in 2013 before it resumes steady state levels of 3% thereafter. Government spending has increased by more than 10% per year in rand terms since the year 2000. Of course, it increased most dramatically during the recession, and that's normal, anti-cyclical fiscal stimulus, which we expect to continue through 2011. Thereafter, we expect government expenditure to grow at a rate of between 10 to 12% per year, which means that by 2015, it will reach just over $100 billion US, which is just a little under a quarter of GDP. And with respect to gross fixed investment, the 2008 peak really came from World Cup-related infrastructure investment. Usually around 70% of gross capital formation comes from the private sector, with 20% from government and the balance from public corporations. That's why it fell so sharply during the recession. Although its share of GDP has increased over the years, to sustain GDP growth of 6%, this element of spending needs to increase from these expected levels, which are about 18% of GDP, to 25% of GDP. Finally, South Africa's current account deficit is expected to widen from an estimated 3.9% of GDP in 2010 to 5.5% of GDP in 2011. Why? Exports are not going to keep pace with imports, and that's because of fragility in key OECD markets, so the trade deficit will widen in 2011. The far larger invisible deficit, which includes services income and current transfers, will also increase. Service inflows have already been weakening after the World Cup, while income outflows to foreign investors will rise in line with higher capital inflows. Current transfers will remain negative throughout the forecast period because of payments to fellow members of SACU, and similar trends will be evident in 2012 as faster GDP growth and South Africa's strong demand for capital goods pushes up imports more quickly than exports. The invisible shortfall will remain large, leading to a rise in the current account deficit to 5.9% of GDP in 2012. In 2013 to 2015, with a slowdown in the economy and investment in import substitutions such as oil refineries, weak import demand is likely to weaken, while more rapid global growth and brisk demand from other emerging markets, including Africa, boost exports. So thereafter, we expect the current account deficit, or the external balance, to narrow from 5.7% of GDP to 3.6% of GDP by 2015. Moving on then from the external balance to trade, I've already mentioned that China is South Africa's main trading partner, as the media continues to remind us. But it's worth remembering that South Africa has a diversified set of partners. In terms of the type of exports or what we export, 60% of all imports fall into the 5 categories that you can see here. And for those of you that don't know the harmonized system codes off by heart, 27 is mineral fuels, oils, and distillation products. 84 is boilers, machinery, nuclear reactors, and so on, so capital equipment. 85 is electrical and electronic equipment. 87 is vehicles other than railway and tramway, so predominantly cars, trucks, you name it. And 95 is toys, games, and sports requisites. South Africa has the most diversified export market of the top 6 African economies. It was worth $53 billion in 2009, which is actually a shortfall compared to the previous year because of the recession. In the previous year, it was $20 billion higher. Going down the table, pearls, precious stones, and metals and coins make up the largest single export category, and in fact represent nearly 3% of world exports in this category. The segment is dominated by platinum. 28% of the world's primary supply of platinum comes from South Africa. Moving on to mineral fuels and distillation products, this is the second largest segment, as you can see, and that's because it's dominated by coal. 5% of world coal exports are sourced from South Africa. The following line, number 26, consists of ores, slag, and ash. More than half of this is iron. Nonetheless, South Africa's market share in rare metals, rare earth metals, is noteworthy. 40% of chromium exports, 23% of manganese exports, 54% of titanium, and 37% of niobium, tantalum, vanadium, and zirconium. 12% of precious metal ores and concentrates. With respect to iron and steel, which is number 72, just short of 20% of that, as you can see, goes to China, with still quite a significant diversification there, even in the case of iron and steel. What is interesting here is that I have always thought of South Africa as being quite an open country with respect to trade, certainly since '94. But it's actually far from being the most open country in Africa, either in terms of goods or services. So if you rank all the countries in Africa and you calculate the scores for the export of both goods and services, which is divided by GDP, which is how you calculate trade openness, South Africa falls into the bottom quartile for goods, and with respect to services, is 5th from the bottom out of a list of 37 African countries.